What's up, traders? In today's video, I would like to talk about why I never trade naked options anymore. So no more naked trades for me. I will first talk about what trading naked options looks like, just so that viewers know. So one of the things that I do most is sell options because I like to collect the premium and benefit from theta decay and volatility collapse and all those things. But selling options for me is the best way to generate income from trading. Well, one of the main strategies that people tend to use is iron condors, and I will use an iron condor template here to show an example of a naked option trade. So I don't even put actual naked strategies in the templates because I don't think that it would be good for somebody to unwittingly go in and add a naked option trade and submit an order. But they're easy to create just by doing something like selecting an iron condor, which in this case, this one has a risk profile like this. I'll make it more realistic. I don't think anybody would ever create an iron condor with the wings that close to the money, but it would look like this. Now, if I wanted to make this naked, I would just get rid of these protective calls like that and get rid of the put. And then you have what is called a strangle. So with this strangle, you're selling a put, you're selling a call, you're hoping that the price stays within this range. But if you zoom out in OptionSmith, it gives you a real good view of what the potential loss could be. I mean, we are at a maximum profit of 768. This is on Tesla. But if the stock plummeted or went to the sky, you're looking at like 29,000 in loss. Now, the reason people do trade these sorts of trades is because you can depend on the fact that it's very unlikely for the stock, if it's an established stock, you would especially never want to do this in a stock that could go a huge distance. But in an established stock, you can depend on the fact, or I shouldn't say you, I would depend on the fact, I don't recommend this for anybody, but I would depend on the fact that it is highly unlikely that the stock would go that far. And also, you can put stops in place to get out of a trade if it starts to go too crazy. But it's still a lot of risk if something really unexpected happened. I've traded a lot of naked options in the past. I've traded strangles. I've traded cash secured puts, which I still do in long-term investment scenarios. I'll talk about that a little bit later, but that is different than just selling naked options with leverage. So with leverage would be like the amount of loss that you could potentially incur is big compared to the amount of cash you have in your account. But for a strangle, you can control your risk that way by planning to get out when it reaches a certain loss. You can plan to continue to roll these forward in time, but you could still get in a hole where you keep getting deeper and deeper as the stock moves against you. You can do the ultimate no-no, which is selling a naked call, and so then you've got what is theoretically unlimited risk. So you see that infinite sign, which is very scary. The chart max risk, infinite. So yeah, that's all like big and scary. And when people talk about losing their shirt trading options, that's one way that you theoretically could do it. The way most people do is they actually end up over leveraging and buying a ton of options that on margin that they shouldn't be, and then that all goes to theta decay or a volatility expansion and or collapse, and they lose it just because they're over leveraged. But the reason I no longer trade naked options is not necessarily because of that tail risk, so to speak. It's because the whole reason I went back to trading options instead of futures and stocks is because I found that it works best for me to have the control over the amount of risk that I'm taking, the max that I can lose, just, and this is the key, just by letting the position play out entirely. Because I found anytime I have to use stops, whether it's a stop order or a mental stop, I am decreasing my probability of profit too much for me, the way I trade. So, and by that I mean, if my trade starts going against me and I have to get out, I'm not letting it play out the way it could have. There ends up being many trades where if I had just let it go, it would have come back into profit. And so that part of it I no longer want in my trading plan. I want to be able to know that if I just let the trade play out, that this is the maximum loss that I will take, and that fits in with my trading plan, and that fits with the profit loss scenario that I'm willing to take for a trade. So I've mentioned before I usually use broken wing butterflies, but another example of non-naked defined risk trades is credit spreads, iron condors, regular butterflies. So if you're controlling the amount of risk that you take to the maximum, in the sense that you know you don't have to worry about trying to get out of the trade if it goes against you, for me, that is the ideal trading style. And so that's why I no longer trade naked options. One thing that I mentioned is I do, for my long-term investing, sell cash secured puts. And what that means is that I have the cash to cover if I were assigned the naked put, so to speak, that I'm selling. But I don't even sell the puts naked. I actually always now add a very, very cheap protective put, so that it does have the advantage where if suddenly the stock or I use SPY mostly, if that went down 50%, I could get out and not lose everything. But it also allows me to have just a slight bit of leverage, and it allows me to sell, for example, 2 puts where I wouldn't quite have the cash in the account to cover that, especially if through the trading the stock keeps moving up, and then it would require more and more cash to be able to fully cover that. So here is an example where I sell these puts, usually right at the money, and then I buy like cheap $10 puts to protect them, so to speak. They're protective puts, but they're not really, they're not there to prevent a potential big loss, because I look at this like I'm not buying the stock, but it's similar. And so it's for a SPY, it's a big account. And what I do is I sell the puts at the money, and I sell them at 45 days to expiration. If at 21 days to expiration the stock has moved so that those puts are in the money, I just roll them forward in time. So I do an order that closes the ones that are at 21 days to expiration, opens puts, short puts, at 45 days to expiration, but they are at the same strike. So that's if they are in the money. So that way I collect more premium, because there's still some extrinsic value in those options even though they're in the money. I collect more premium, I extend out into time, and I continue to roll forward at that strike price until the stock, or SPY in this case, moves up past those and they're out of the money. Now, if they're out of the money when they reach 21 days to expiration, Then what I do is I roll and I move and I roll up as well. I roll forward in time and up. So there are 21 days to expiration. I will go out 45 days and I will sell puts at the money at that point, close the ones that are out of the money. So when I'm doing that, I'm moving with the stock. I'm collecting the maximum amount of extrinsic premium that I can because I'm selling right at the money again. The ones that I closed out that were at 21, they took a lot of profit. But at that point, at 21 days to expiration, there is a lot less extrinsic value in those options. So for me, it's not worth the risk anymore. I could just let them expire. I could let them go all the way to 0 days and have a lot of quick theta in there that would benefit the portfolio rapidly if the stock continued to move or stay in the direction I want it to. But the amount that I'm gaining for that risk at that point isn't worth it as much. So that's why I always roll forward. But that's just cash secured puts, so to speak. Again, I have some protective puts, so it's technically not cash secured. It's still defined risk. But because it's such a big amount of potential loss, because I'm looking at it as though it's the same, almost the same as just buying 100 shares of SPY per put. That's why it's similar to cash secured, or it's similar to naked, but it's cash secured with protective puts. So anyway, that's more long-term investing. For me, this channel is more about options trading. So in summary, I don't trade naked options anymore. I use defined risk, but not because of the massive tail risk of trading naked options. It's because of the ability to control the exact amount that I would lose if I just let the trade play out to its completion. And when I have that, I have way more predictability in the outcome of my trading plan. I'm not dealing with arbitrary amounts of loss or profit all the time, where should I have gotten out earlier, should I have closed it earlier. That there's too many variables there for me. Again, this whole concept is about why I trade this way, and it's not saying that this is the best way for other people to trade. This is all just explaining my process over 15 years of options trading, and then 25 years of actual trading, where I have arrived to find the ideal way of trading for me. And so that is why I no longer trade naked options. Thank you for watching, and we'll see you next time.